Bismillah ar-Rahman ar-Rahim. Assalamu alaikum and good afternoon, good evening, good morning, depending on where you are. Welcome to this session we set up today on a very important topic in terms of affecting the global financial markets. We have set up the session in coordination between UK chapter of ICAP members and Institute of Chartered Accountants of Pakistan. And I would like to welcome all of you. Hopefully, we will have a fascinating discussion on this topic in the next hour and a half. I would like to thank our panelists, and I'll introduce them a bit later as well. And I'd also like to thank Ali Latif Saab, who is the Vice President North, for joining us, and Ashwat Tola as well as special guests for this webinar. Before getting into the details, I think I'll just spend a minute on the UK chapter of ICAP members. We have been here in the UK for more than 10 years now. I think this was the first chapter which was set up by ICAP, and then it started in other areas as well. Just reflecting on our membership, I think we've got about 300 members roughly now in the UK. And the good thing about them is all of them are progressing well in their careers. Some of them have even reached the C-suite levels at organizations. Some of them are partners at Big Four and other top audit firms and consulting firms. And a few of them have become entrepreneurs as well. So it's a fraternity I am very much proud of, and I think ICAP should be very much proud of as well. And there are a lot of good things to come from this fraternity in the future as well. So with that, I'll just pass it on to Ali Latif Saab for a few words, and then we can start the session formally. Ali Saab, thank you.
Thank you, Shoaib. Bismillah ar-Rahman ar-Rahim. Honorable panelists, organizers, and esteemed participants. Assalamu alaikum and a good evening, and a very warm welcome to all of you. Thank you for being part of this informative ICAP webinar series. First of all, I would like to thank and appreciate the efforts of Mr. Ashfaq Yusuf Tolla Saab, who will be joining us soon. He's also the Vice President of the Institute and the Chairman of the Overseas Coordination Committee. And he really went in and shook hands with Mr. Shoaib to bring you this seminar, this fascinating seminar, just like Shoaib mentioned. But he had just pulled an all-nighter, and he'll be joining us soon because we have got the budget coming up in Pakistan. And it was just announced yesterday that he was busy preparing the commentary. And he will be joining us with us in probably half an hour or so. I would also like to thank Mr. Shoaib John Maiman, Chairman UK Chapter, for organizing this webinar with ICAP. And I really look forward for a healthy discussion for the benefit of our fraternity. Please join me in welcoming our esteemed panelists, Mr. Daryl King, who is a project management and transformation specialist, Mr. Frank Stoltz, who is a product control and valuation specialist, and Mr. David Bradley, who is a director of financial services at EY. All our panelists are seasoned professionals, and I'm sure that this session will provide us with an opportunity to learn from them. The topic of today's seminar, as you all know, is IBOR transition, end of LIBOR, and I'm sure this will definitely pique your interest because the interbank offered rates, whether denominated in dollars or in sterling, have been used globally as the benchmark interest rates for lending. These are expected to be phased out in December 2021, and this might leave the financial market without its most used benchmark rates. This will impact around $400 trillion worth of financial contracts. This transition away from IBOR will have its impact not only on banks, but all financial services institutions, corporates, as well as all individuals. This change from IBOR to the new interest rate will impact borrowing, derivative trades, even financial contracts, and hopefully we as students are all eager to learn from our esteemed panelists how this is going to happen and how it's going to impact us all. So without any further ado, I would request and give the floor to Mr. Shoaib. Over to you, Mr. Shoaib.
Thank you, Ali Saab. Thank you for the introductory comments. Getting into the mix of things, I think the topic, as you mentioned, this is something which is affecting the global financial markets at a large scale right now. Sitting here in London, I think we've seen a lot of work happening in this space over the last few years, and there's more to come. So probably this is not the beginning, but this is not the end as well. So it will certainly occupy a lot of people over the next couple of years, particularly The markets are waiting to see how this transition will all settle down as well in the future. You've introduced Alisa, the panelists already. Just reflecting on them quickly, I know all three of them well. I think I've worked with all three of them as well. And they bring in their own individual skill set and expertise as well. So hopefully the conversations will be entertaining and we'll learn a fair bit from them within the hour or so we've allocated to this, although this topic would probably take months or years if you want to have a more detailed discussion. But this is, as I said, this is just something which we wanted to sort of reflect on for the wider membership base, and hopefully this would be of interest to everyone. So let's start now. Daryl, who is a specialist in terms of project management, has delivered a lot of change programs at large institutions, mid-sized institutions, and works as a consultant. Frank, who is Frank Stolz, who is a valuation and product control specialist, but wears many hats. He's looked after the management information. He's looked after budgeting, planning. So has experience in a number of areas within the finance area. So we'll be reflecting on that as well. And David, as I mentioned, he's somebody I've discussed quite some intense topics with as part of his engagement with EY, Ernst & Young, in the recent times, and is a specialist within financial services, consulting clients and banks and financial services. So starting with Daryl, I guess let's just talk about, what is driving this change? What is IBOR, and what is exactly the reason why we sort of seeing this happen now? So, just wanted to get your views in terms of how you see what is the background and why are we at this stage in terms of the change?
Yes, hello everyone. So fundamentally, for those who know or don't know, IBOR stands for interbank offered rates. These are term rates which banks have traditionally used to set their levels of interest for loans and also deposits. They are set in 5 currencies. So for those who don't know, US dollar, sterling, we've got yen, Swiss franc, and we have euro as well. And they're set in a variety, a range of tenors. So I think it's important to understand what these are, and I'm sure you've all come across them in one shape or form in your professions. These rates have been set by a panel based on activity in the market. The regulators over the years have been slightly concerned that this is a slightly antiquated way.
Is there, Akbar, could you hear it properly?
Daryl, sorry, we lost you. Can you hear us? There's a fair bit of echo. No. That's fine. You can take your time in terms of sorting it out. We'll just move on, I guess, if you want to spend a couple of minutes sorting the microphone out. So, Frank, I think I'll just move to you in terms of the process which was being used for setting up of LIBOR curves in the past. Daryl was talking about it. Do you want to just reflect on this a bit more in terms of what was happening in the past and what are we expected to see in the future?
Yeah, I guess as Daryl already said, LIBOR has been used widely for wholesale transactions, but equally so for valuation of a lot of sort of derivatives across the globe, really. The impact of the change now is to move away from these LIBOR rates for many reasons. I think in terms of there were concerns around reliability of the quotes in the market and so forth. And there was always discussions around whether they are risk-free or not risk-free, and whether you know or not, there has always been an element of credit risk in there. And I think with starting with financial crisis, I think there was a move to, especially on the valuation side, to basically transition to a more risk-free benchmark. And initially, these were overnight rates in general. And I think then there was a move to finding those new RFRs or ARRs. These sort of terminologies are alternative reference rates or replacement reference rates. Now, as Daryl said, there is many currencies and there are different sort of approaches here, but it will impact, I think, both the sort of normal corporate lending and wealth management, borrowing and lending, as well as the derivatives valuation. These are the main three areas. So really and truthfully, it will impact each bank's and corporate's balance sheet.
Okay. Well, thank you. That's very helpful. So I guess what we're talking about, just for the wider, the interest of the wider audience. So we're talking about effectively contracts which have interest rates determined or linked to US dollar LIBOR, sterling LIBOR, Swiss franc LIBOR, Euro LIBOR, and so on. So all of these contracts are going to be affected, and we'll go into a bit more detail in terms of the timing and the approach and so on. But just going back to what you mentioned, and I think Daryl touched on this as well, the regulators were concerned about the feeds they were receiving. And I think this became a bit more, was more highlighted during the financial crisis, where perhaps the view was that the rates which were coming in from the banks as part of this exercise to determine the LIBOR, they were probably not correct, because the market was going through a lot of pressure at that time, but this was not obvious in the rates which were coming out. Would that be a correct reflection? I don't know, Daryl or
yes,
Frank,
I think if you hopefully you can hear me now. Absolutely, I think that was one of the concerns where the market, particularly linked to LIBOR, wasn't, or had become decreasingly sufficiently active. As alternative rates were being pursued by banks and financial institutions. And I think it was even more heightened a number of years ago, where certain vulnerabilities were spotted in influencing, or certain unscrupulous individuals influencing the LIBOR rates and the panel on how and where they were set to the firm's benefit, or in some cases the individual's benefit. So that sort of put the tin lid really on the reason and rationale for change, and looking for more appropriate rates, some of which Frank mentioned earlier.
So in essence, I think that the process, the change in essence started with post the financial crisis, as far as the sort of the global mandate the regulators took on themselves to review everything around the global financial system, how it was working. So that sort of triggered, and now we're more close to sort of seeing the end of that change, the process of change, whilst the journey is still as begun for the actual change itself. So that's very clear. Thank you. Now the question is, what are we seeing in terms of what is IBOR going to be replaced with? So let me pick it up with David. I think David, welcome back. I think you had some issues with logistics at your end. So what is IBOR going to be replaced with, and what are you seeing in terms of some of the things happening in terms of replacing the LIBOR rates as we have right now?
Mohammed,
sorry, David, you there?
I can.
Yeah. Okay, Frank. Let's start with you. Yeah.
So I guess in the meantime, until David is back, there is, as we said, we have sort of main currencies in dollar, sterling, euro, Swiss franc, and JPY, and the recommendations, I think, for most of the regulators are in future to replace those rates. To replace those rates in particular with what they deem as overnight rates that are reflective of high liquidity and high market volume transactions. And the ideas here are to move all of the LIBOR rates that are term rates at the moment to an overnight index, or a related overnight index. And there is, for each of the currencies that we mentioned, there is a new benchmark that has been recommended. In the UK, it will be SONIA, Sterling Overnight Index Average. In America, dollars, you have the Secured Overnight Financing Rate, short SOFR. And in the Eurozone, it's slightly different. It's ESTA Euro short-term rate, and Switzerland has got their own version, and Japan as well. All these rates are basically based on underlying instruments and quotes of those instruments, and there is a different time scale for the cessation and the transition for each of those currencies.
Okay. Well, yeah. Well, let's pick up on the transition a bit later. But let me just ask you, and I think you touched in your conversation on this already, Frank. So LIBOR itself was not a risk-free rate.
Correct.
The perception generally was that it is, but let's be clear, it is interbank offer rate. So there's an element of risk premium involved in the past, which perhaps was generally ignored, but it was not a complete risk-free rate. And now we are looking potentially at a move towards risk-free rates, or there are still some discussions around how it's going to work?
I think there's still some discussions around it, but they are perceived as being more risk-free. And when you look at the quotes that you see in the market, because they are overnight rate, they have no term risk, first of all, attached to them. And also there should be minimal credit risk on each of those sort of quoted.
Okay, excellent. Oh, thank you. And the other term we use quite regularly, or I think has become more obvious in the recent past, is overnight index swap rates. Okay, so how does that relate to what is being proposed in terms of these alternate reference rates, which you mentioned, SONIA, SOFR, and so on?
Well, they are, in fact, they are slightly different from each other in terms of where they're quoted, and I think the underlying instruments are different as well. But they are very much sort of, when you look at the Fed funds rate, for example, against the SOFR rate, they are very much aligned and they're very similar. It's just the underlying methodology that is different between the two, but they track or trail each other quite closely.
Okay, thank you. Understand that. Now, so we have SONIA, which is Sterling Overnight Index, and then SOFR in the US, and ESTA, and so on. So everyone will come up with a different acronym. And that's another thing I guess we'll have to digest over the years, rather than using the same LIBOR, but put a currency suffix or a prefix. So that's clear. So again, another acronym I think everyone has to get used to. Now moving on in terms of the transition programs, and again, Daryl, I think I'd ask you the question. So what are the key regulatory and industry milestones set? I mean, let's talk about the three main markets potentially, or we're talking about the US dollar, sterling, and potentially euro, in terms of what are the key regulatory milestones set over here in terms of the expectations around this transition.
So starting with sterling, which is more short term in terms of its expectations. So the FCA and PRA have set the milestone of end of March this year for the cessation of any new business whatsoever being written to LIBOR. So very quickly, firms had to make sure that they had non-LIBOR products linked to alternative benchmarking rates, and these could range from SONIA to UK base rate, for example. And an extension of that is by the end of this year, when we look at existing contracts in the existing book of business, all transition from LIBOR to an alternative benchmarking rate plus a credit adjustment spread needs to have taken place by the end of this calendar year. So just to quickly recap, by the end of March this year, no business can be new business can be written to LIBOR, and by the end of this calendar year, all existing contracts need to have been transitioned to alternative arrangements that aren't linked to LIBOR. So that's for the UK. In the US, it's a lot more drawn out, primarily down to the sort of huge volume of business in the US and linked to US dollar. So the cessation of any new business written to LIBOR will stop at the end of this calendar year. So that gives a little bit more time, but the regulator are encouraging firms to be prepared well ahead of that deadline with the ability to write new business in alternative rates. And in terms of the existing contract and book of business, there's an even longer tail, and that takes us out until the end of June 2023. Initially, it was set at the end of this calendar year, but there was considerable pushback by industry in the US, where they felt that given the volume of business, there was no chance of being ready. As Frank mentioned, well, I think it's also worth mentioning as well that for Japan and Switzerland, they are running to a pretty similar timetable to the UK, and so we will see that transition take effect leading up to the end of this calendar year. For Euro, as Frank mentioned earlier, fairly minimal in terms of where the transition is there, and so again, you know, that's really moving towards the end of this calendar year as well, in terms of adopting rates that are all pretty much well used in terms of ESTA and in the market for Euro. So they're the main milestones that the regulators have set.
Okay, well, thank you. So UK is potentially, what we understand, I think UK is potentially fast tracking this. Is spearheading this in terms of the change. So they've already asked, as far as I understand, for any new products post March 2021 should not be linked to sterling LIBOR, any new offerings since then from the banks. And the existing or the legacy book has to be migrated around to the alternate reference rate by end of the year. Would that be a correct summary?
Yeah, absolutely.
Yeah. And then for US dollar, then the expectation is that from 1st January 2022, any new contracts have to be linked to an alternate reference rate, which is say SOFR in this case, or any other they want to use. But then for the legacy book, they've got more time.
Absolutely, yeah, correct. So they've got until end of June 2023 for the legacy book.
Okay, all right, excellent. Now, picking up a bit more on the details then. So differences between what we have in IBOR, and we've touched on one slightly, I guess, in terms of risk-free and not being risk-free and so on. Let me go to David. I think, I hope you can hear us, David. So let me go to David in terms of what would you consider the key differences between what we have right now as part of the IBOR or LIBOR regime versus the alternate reference rates?
Yes, thank you. So a key difference with the new rates is obviously the risk characteristics of the rate are quite different, because the old IBORs, the LIBORs, captured the credit risk associated with the banks that were submitting their rates into the rate setting process, whereas the risk-free rate sort of takes that out, and that's one of the drivers then for the spread differential that we see with the new replacement rates versus the LIBORs, and we see obviously SONIA with a transitioning to SONIA and transitioning to Bank of England base rate at sort of lower spreads than the LIBOR that was replaced. Obviously, also we're losing the term structure for sterling LIBOR. SONIA is an overnight rate, but we are seeing steps across the market to perhaps have a market-driven term structure, but we haven't really seen that fully emerge yet. One thing I would note is that the level of activity in the UK, I think, as you mentioned, is ahead of the other jurisdictions, and so therefore we are seeing a lot of instruments, particularly the momentum gathering to transition legacy contracts. In other locations, as Daryl mentioned, and as you mentioned, so US dollar rate will continue until June 2023. So there's not quite so much urgency to transition, but as was mentioned, new rates, new transactions need to reference the new rates. I suppose the other aspect I would say, determining the adjustment spread that should be applied on transition is important. So ISDA published the fallback rates in March, which would apply when the derivatives transacted under ISDAs, if they're not amended before the rates terminate, then the credit adjustment spread is being determined by ISDA. But I think for all unilateral changes that are negotiated sort of outside of a fallback, then the credit adjustment spread is to be determined, is to be negotiated, but within, I think, people will have in mind the ISDA spreads, fallback spreads that have been published. So,
I think that's an interesting one, and we've got a question on the credit adjustment spread as well. So if we look at the UK contracts, for example, we, on the retail side in particular, we potentially, where we had maybe historically some contracts which were LIBOR linked, and now it's moving towards base rate. Then is there an expectation that there would be a credit adjustment spread on those contracts? David, you want to pick up on that, and Frank, I want your views on this as well. Then.
So yes, I think there is an expectation that there would be some credit adjustment spread. I think the spread is between base rate and SONIA is small. Between IBOR, LIBOR, and SONIA, it's more significant. I think sort of 20 or so basis points, I think I recall. I think there are sort of boundaries of sort of reasonableness, if you like, and so one area that is focus in the UK is sort of conduct risk and making sure that banks treat their counterparties and their clients fairly, and so there has to be a sense that the rate is appropriate and an adjustment spread is appropriate. And also for accounting and reporting purposes, IFRS has this concept of transitions taking place on a basis which is economically equivalent, and where that is the case, then the accounting is much more straightforward. You can sort of continue and treat the change as a floating interest rate, rather than having to recognise a sort of gain or loss immediately in P&L. So ensuring that it is economically equivalent, important for accounting, ensuring that the conduct is fair and appropriate is important for regulatory reasons. But I think realistically, you can expect there to be a little bit of movement in the basis spreads as liquidity in the market sort of, changes, and then that could affect the spread. So some factors to consider there.
Thank you, David. Frank, do you have any comment to make on that in terms of potential adjustments relating to credit adjustment spread and so on? Or
yeah, I think David is absolutely right. I would say there is no explicit mentioning that you must apply a credit adjustment spread. I would think, though, that judging from the sort of ISDA announcements and what happens sort of widely accepted and published in Bloomberg, those credit adjustment spreads are fixed in that respect now for each of the tenors moving away from LIBOR. I would assume that considering the treating customers fairly, i.e. the conduct risk, as well as the requirement to create economic equivalence, this would be looked at when you start to transition your legacy book with your customers and you're picking up discussions with your customers. So I would assume that there is an expectation that some form of adjustment spread is to be negotiated on your sort of bilateral loan agreements and be it deposit agreements that you have in place. I think there was the sort of question, if I remember sort of correctly, or see from the chat, there's a question also over which time the credit adjustment spread is being determined, and that's obviously a question related, if I understand, to anything that is an alternative rate, not a SONIA or SOFR rate, and whether that has to be determined as well. I would say there's two aspects to consider. There's the bank's aspect to consider and the customer's aspect to consider, and both would have an expectation that there is some form of adjustment with a clearly communicated methodology behind it.
okay, no, thank you for that. Now, the other question which comes up when we talk about this topic in terms of the actual calculation of the interest. So, and then I've got a question in terms of the term as well, I guess, particularly because if you look at the what you see on the be it on US dollar and sterling and so on, you have clear term rates provided over there in terms of 1 month, 3 months, 6 months, and 1 year, and so on. So how is that going to work? And any other nuances in terms of the actual calculation of these rates as well in the future, which you want to pick up? Let's start with you, Frank, and then we can get some views from David as well.
Yeah, I guess there is some key elements to consider. First of all, the LIBOR rates are forward-looking, so you always know what your rate is when you enter into a contract for a future period. That is going to change significantly, because now you're talking about overnight rates, and you're only going to know what your series of overnight rates is for a certain period, backward-looking, which basically also results in the fact that you not quite know what your future cash flow is going to look like over a fixed period. In terms of calculation method, high level, very high level, you are retrieving rates that are published in the market, be it SONIA, SOFR, or other RFRs. You then have to consider your conventions that you're applying. There are different ways of calculating this, let's put it like that for now. Then you apply the compounding factor to your underlying benchmark. And I think one thing to bear in mind is that whilst LIBOR was easy to calculate, if I may say, you had the underlying benchmark plus a margin, and you could add the two together, and you would be able to tell the customer easily where the 1 month or 3 months sort of interest rate or interest payment would be. That's not as easy anymore, because you differentiate the reference rate, which needs to be compounded, and the margin as such will not be compounded, will be a simple interest calculation going forward. And then the other element, I guess, to bear in mind for the legacy book is whether or not you apply a credit adjustment spread.
Okay, well, thank you, David. Any comments on that?
Yes, I think one other aspect to bear in mind, particularly with the loan arrangements, is when the bilateral discussions take place to amend them. Inherent in that sort of dialogue.
Sorry, did we lose David?
Yes, I think we did.
All right, okay.
I think there's just one small point to sort of add. I think it's also important when looking at the legacy book that the business is careful to determine what's an appropriate new arrangement. So certainly from some of the work that we've done and what we've seen in the markets is, what's appropriate as a corporate loan compared to a personal loan that you would look to transition. So we're hearing new terms like SONIA and SOFRA as risk-free referencing rates, but depending on the nature of the loan agreement and who your client is, you've got to take into consideration what's appropriate there. Is it to adopt SONIA plus the credit adjustment spread, or actually if the loan is of much more of a personal nature or retail nature, then you may well look to, in Sterling's case, look at UK base rate plus an appropriate credit adjustment spread. So again, there needs to be some careful thought around what's appropriate for the customer.
Yeah, I think that's right, and I think there is in the UK, there's a school of thought whereby you obviously identify your portfolio by product and by client segment, and then there is a recommendation in terms of what the most appropriate rate would be in that sort of selection process, and I think that sort of goes into the question. I think that was raised around whether there's any alternative to SONIA, and I guess UK base rate is one, and I would assume that we've got the SONIA term rate as well as another alternative, although I think there is a push, obviously for obvious reasons, from the regulator to make sure that the majority of the portfolio is moving into SONIA compounded products.
Okay, I think we got David back again. David, sorry, we lost you.
Yeah.
Any comment you want to make on this? Oh, we lost you again. Okay, all right, let's try to move on that point. So again, just reflecting on this point, Frank, we have just going back to the term rates question.
Yep. Okay,
so you mentioned there is expectation that, well, there will be a SONIA term rate, but the expectation is that they from the regulators is to use something different. So how is it going to work practically in terms of refixing of pricing of contracts in terms of so if you have an interest payment due, for now there is certainty that, okay, on that, for example, on that due date, you look at it's a quarterly repayment, quarterly payment cycle. You look at the 3-month rate, 3-month LIBOR right now. When what it looks like, you use that, add the spread to it, and work out what your next payment is going to be. So how is this all going to work? Let's just look at this a bit more in detail. How is it going to work in the future?
Well, in the future, you will basically look at a loan that starts at a certain point in time. And what the current recommendation in SONIA in the UK is basically you're at that point when you start your loan, you are starting to look back 5 days. So you look at a series of previous days rates of 5 days, and you start sort of compounding from that point in time. So you've got almost a 5-day window where your rates are known. And that also applies to when you hit the interest payment date. So say, for example, you start the loan today and you agreed a payment frequency of a month, then in a month's time, you obviously have to have your payment due. That payment will then be calculated based on a series of 1 month's overnight rates that are compounded on a daily basis. And essentially 5 days, working days before your interest payment, you will know what your interest payment is going to be.
Okay, so it's not going to be as certain, I guess, as it is right now. That's in essence you're saying. So, you would still have some kind of look back period able to give you some more comfort around this, but it's not going
Correct.
to be clear in terms of how it's going to work. So let me put this question to David now. David, I guess, looking at purely from an accounting perspective, for now, if corporates or individuals or even banks have got contracts out there which are linked to a 3-month LIBOR in terms of calculation of interest costs or revenue, whatever the case is, you have certainty. How is it going to work from an accounting perspective when you know that there is this element of uncertainty that's going to come in when it comes to accrual of income and so on?
Yes, so the way the accounting is intended to work is to allow the changing interest rate to be treated as a change to a floating rate. So just to flow through, so this transition should, in theory, not give rise to any sort of undue, unexpected P&L volatility. The Accounting Standards Board really tried to make IFRS as amenable to IBOR reform as it could. It tried to avoid problems arising. So provided the transition of the loan, or the derivative of the loan rather, takes place on an economically equivalent basis, then it will pass through as a floating rate. If there are other factors that are included in the change at the time of transition, perhaps the credit spread is updated, perhaps because the counterparty's credit risk has changed, then that potentially would not be allowed to be treated as a floating interest rate. That piece of the change, that would go as a immediate effect to P&L. One other aspect to consider is the effect on hedge accounting as well. So where the interest rate risk on loans, for example, has been hedged with interest rate swaps. Again, IFRS is trying to allow hedging relationships to continue even when instruments transition. But again, it comes back to ensuring this concept of economic equivalence is maintained. Because if the change to the loan or the change to the derivative is such that it sort of goes beyond what might reasonably be expected for IBOR reform, then the hedging relationship may need to be discontinued, and then you could have P&L volatility arising. So keeping an eye on those factors is going to be important.
Okay, so hedging is another area. Okay, but let's we'll pick up on some of these elements in a bit more detail again when we look at how it's going to impact corporates and banks. But let's start with the banks, I guess, and a question for you, Frank, and then we'll come to sort of the transition programs and Daryl, I guess, just to understand how this is overall being managed. In the meanwhile, I think certainly just a point to note, I welcome any questions from the audience. If there are any, please do send them across. We've received a few already, and we will try to address them as we go through these conversations as well. So if I am a CFO at a corporate, if I am a CFO at or a treasurer at a corporate, how is this all going to impact me? We've talked about a lot of technicalities, but just give me 5 areas which, David, I guess starting with you, which I would be looking at very closely as to how it's going to impact the corporate business.
Yes, so I think the most important thing is to have a program structure in place that can track the progress of the transitions across the portfolio. Because as was mentioned at the start, there is a time frame that's running when these rates will cease. The fallbacks will kick in for derivatives. So a corporate needs to make sure that it has its arms around the population of instruments that will be affected, that where necessary negotiations are taking place with its lenders, with any other counterparties, because LIBORs can come up in all sorts of agreements, even leases. You can have LIBOR linked leases. So you really have to keep an eye out for that. So that's, I would say, the first thing. The second thing is then to make sure that there is enough time to have the discussions needed. So particularly one area where we've seen challenges arising is with syndicated loans, where there may be many participants, perhaps different banks that are all maybe spread across different geographies. Everyone needs to agree on the credit adjustment spread, and that needs to be coordinated. So participants in a syndicated loan need to be having those conversations and to bring the plan forward.
Excellent, thank you. And then, whilst well, it all depends, I guess, the significance of this. But what are you seeing in on the corporate side in terms of disclosures around all of this change as well? Are you seeing a lot happening there? I know in the UK it's a big topic and there's a lot of discussion, particularly in the bank's financial statements and so on. But more on the corporate side, what are you seeing there?
So I think on the corporate side, what we've seen is that so far there hasn't been that much progress in terms of executing the transition. That's due in no small part, I think, to COVID and all the disruption that caused. Originally, I think there was an expectation that in 2020 more instruments would transition, but I think people have just been sort of understandably keeping the business going. So we are seeing a squeeze of effort that is going to have to take place for the sort of sterling contracts in the second half of 2021. So we think there'll be a lot of activity going on to sort of fit in with the time frame. So
okay. Yeah, thank you. And you already mentioned about sort of in terms of hedging relationships and how this might transpire for some of the hedging contracts in place. That's again an element which we need to be mindful of. Okay, thank you. Moving to you, Frank. Then from a bank's perspective, I guess again, top 3 or 5 areas you think the banks have been working on, because I'm conscious of David's comment. I guess the corporates perhaps have been a bit slow in reacting to this, but the banks have been, in a way, nudged to look at this quite a few years back and by the regulators and so on. And obviously, the impact is much more bigger on banks and financial institutions than perhaps it is for the corporate. So, from a banking perspective, what would you consider the 3 or 4 areas which you think are key as part of this transition?
I would say, let's just assume for a moment that you know your portfolio, and then I highlight the points. I think if I assume at this point, which I guess Daryl is going to come to anyway, in terms of the transformation process. But one key area to me is the contractual agreements. And that can be quite significant because, for example, you could be a bank with standard agreements, you could be a bank where you have individual agreements, you could be a bank that has a combination of bilateral agreements and syndicated, as David mentioned. And therefore, when you're in the syndicate, you basically rely on a third party really to sort of tell you about what changes they anticipate to do. So legal sort of agreements around your portfolio need to be well understood. That's one area. The second area I would say might be pretty obvious is system capabilities. Now, most banks, I think, operate on multiple systems, and not all the systems that the bank has are capable of dealing with the intricacies of compounding rates. So I would say that's another sort of key element. And then I do think you got to sort of differentiate also the standard lending or borrowing with the derivatives side. So if you're a bank that has derivatives, I think there is quite a big focus, I think, on both on the valuation as well as on the sort of capability again, I would say, of dealing with these products. In particular, and I think that's just been a recent discussion I've had, in particular the area of how our LIBOR-related derivatives are going to be migrated, especially in the UK, obviously, where most of them are cleared. What's the process of that? And then the pricing area really, and the impact to the bank's bottom line.
Okay, so quite a few things to watch out for. Now, we already talked about the conduct side in a couple of comments we made earlier, just in terms of the engagement with customers. And again, there's a lot of push about having this engagement fairly early on. So this will be part of the transition program, and I'll come back to Daryl on that as well. But we got a question here, and I think let's pick it up. This is a term which has been sort of generally used, where banks refer to, in the past, they refer to LIBOR as, in essence, cost of funds. I think it's used vaguely, in my opinion, but that's what the banks have sort of been using, perhaps in the past. So that cost of funds measure is changing. Now, how it impacts the pricing of products in the future, again, would vary on the number of points we already touched on, in terms of whether there's a need for a credit adjustment spread. There is going to be some uncertainty around the calculation of the rate itself, with the look-back period and perhaps a lack of term rates as well, and so on. Would you agree with that, Frank?
Absolutely. It's a fundamental shift from how banks have operated for quite some time. And I think, from my point of view, it also depends, obviously, of the size of organization you are. They have different challenges, or if you are a market leader, then you might be closer to the action, if I may say so, than if you're a small or mid-sized kind of bank.
Okay, I appreciate that. And then valuation was the other element you touched on briefly. So again, I think a lot of valuation of products are linked to LIBOR, and again, that is all going to change out. Has already started changing, I think, in the last few years, linking it to overnight index swaps and so on. Yeah.
Correct. Absolutely.
Yeah. Okay. Thanks. So Daryl, moving to you, then the transition program end to end. I guess let's pick up on some of the key elements you would expect to be covered within this. I think the message we've already heard is, do not underestimate the size of this transition. It depends on your exposure and so on, but it is a significant effort. So let's pick up on what would you consider, how would you run a transition program moving away from LIBOR to the alternate reference rates and so on?
So one of the main challenges, everything that's been raised so far during this conversational webinar, you need to have a transformation program that picks the whole lot up. And as you can imagine, the regulators are taking this incredibly seriously. So they insist on every firm to confirm and assign a senior executive within the firm to be accountable for the transition, and particularly the FCA and PRA have made that clear from the start. So it's got to be, the tone from the top and led from the top is absolutely key. The key elements, certainly looking at your business model, David mentioned earlier, everything that is linked to LIBOR, whether it's a trivial reference in terms and conditions or a standard operating procedure, or actually you've got a significant portion of your lending portfolio in corporate banking. All of that needs to be looked at as it's relevant and needs to be transitioned or changed. I tend to look at things when structuring a program in two parts really. One is you're looking at new business and moving forward there. So what new products, what new types of facilities do you have set up to serve your clients and customers? So new types of loans, new reference rates, which we talked about earlier, and the existing book, the legacy book. We've already spoken at great length and some detail about how you look at that and how you put in place alternative arrangements. If you can just imagine what sits behind all of that, you're looking at operations, systems, and a lot of legal changes as well. A lot of this doesn't happen overnight. You have to look at all the implications of what you've currently got today as your as-is business model, and then quickly work out, what that looks like in the future as your to-be business model. And Frank mentioned earlier on, if you're looking at a level of sophisticated calculations to compute suddenly compounded in arrears, then your systems need to be changed and adapted to deal with that. And one of the main challenges that certainly banks have, they don't necessarily have up-to-date systems. So a lot of extra thinking and work needs to go on here in the background to really problem solve that. I touched on the legal side. Before I get into that, a lot of mention has been made in reference to conduct risk and treating customers fairly. This is really key, and it's something that the regulators are very focused on, very concerned on. As you can imagine, this will have a massive impact, not just on the corporate, the banking side, but also the customer as well. So if you're looking for an existing deal, change the arrangements of the agreement, just how careful are you about making sure that they're clear about these new arrangements, and also about how you're achieving economic equivalence. In addition to that, if you are introducing new products, more compliant products with that move away from LIBOR, then how are you actually educating your clients, and then how are you making sure that they are you're providing or promoting the right products and services for that particular client? So you're getting your client segmentation right with the right marketing, and again, looking at the treating customers fairly principles, you're making sure that the client does actually get offered the deal that's right for them and priced accordingly. Again, what sits behind all of that is there's an awful lot of legal work that needs to go on. Certainly looking at existing contracts, making sure that any amendments that are made to the clients, that they're appropriate and clear. For new products as well, you're in many respects, particularly with corporate loans, you're changing almost like a bit of cultural understanding here. So whereas LIBOR is a forward-looking rate, you're suddenly asking a client to consider a backward-looking rate, and probably they won't know, and you won't know until the tail end of the interest rate period, what they're going to pay in interest. So that's a massive shift in the corporate market for lending and treasurers to understand. And then one final element, I appreciate there's a lot that I've mentioned there, but one final element is training and educating your staff. They've got to be really clear and equally equipped to help and serve their clients and customers, and make everything as transparent as possible about the new arrangements for new products, and indeed any changes involving their existing agreements.
Oh, thank you, Darryl. That's I think an excellent summary of what needs to happen as part of this transition program. So it is end-to-end, I guess. You talk about products, you talk about pricing, you talk about legal, firstly, I guess you need to make, as David mentioned earlier as well, you need to be certain about the population of contracts which are going to be affected, be it a trivial lease agreement sitting somewhere, or a massive sort of financing contract which you're part of as part of a syndicate. So agreed systems, people, training. So it is quite extensive in that sense. David, do you have any comment to add in terms of what you're seeing with your clients on the transition programs? Anything which Daryl hasn't picked up you want to mention here?
Just one other aspect to consider, and it relates to the accounting aspects, and it concerns the topic of disclosure, financial reporting disclosure. So inherent, I think, in all the steps that Daryl described is obviously the challenge and the sort of largely probably operational risk to make sure that it actually gets done in time. Now, the IFRS accounting standards, IFRS 7, which is relevant for financial instruments, normally excludes operational risk from the disclosures. But in this instance, in the case of IBOR reform, it is a requirement for entities to show how they are progressing with their program, and we see sort of increasing levels of detail. Certainly for 31 December 2021 year end, whilst a lot of the LIBOR, sterling LIBOR, will have transitioned, to the extent that there are other LIBORs, US dollar or non-LIBOR, so rates in other countries, then those will need to be captured and quantified to show users of the accounts how well the entity is progressing with their reform efforts. And we see that that can be quite a challenge for entities to gather the information, because it's not necessarily information that's already in the finance systems. It may be gathered and provided to regulators, provided to senior management, but is it really sort of auditable, and is it of a quality that directors are comfortable putting in the financial statements? So that's one aspect. There's a question around materiality. So I think you don't have to really be as accurate for the IBOR reform related disclosure as you do for the other elements of the financial statements, because it is a inherently temporary disclosure. Once the reform is completed, it's no longer required. But that's certainly another aspect to bear in mind. Yeah.
Thank you. I appreciate that. I think that's a good point. And just speaking up on that, we've got a question. I think this is an interesting question. So this is about project financing. So where you have long dated loans and cash flow certainty is important, and hedging instruments are widely used. So what does this change mean for projecting cash flows on long dated instruments? I don't know if David, you want to pick up on that, or Frank?
I can perhaps kick off. So there's just one aspect from an accounting perspective that's especially relevant, and where you've got a hedging relationship in place that requires that a future cash flow is highly probable in order to apply cash flow hedge accounting, and we see that in project finance transactions. Because we know that the instrument will transition from an IBOR to a replacement rate, then that brings in some uncertainty to the cash flow, and normally that could cause hedge accounting to be questioned or even discontinued. But the accounting reliefs say if you've got uncertainty arising just because of interest rate benchmark reform, then you can overlook that for the purpose of accounting. You can ignore it and assume that in actual fact it's still highly probable. So that's a helpful relief. But so one to bear in mind.
Okay, so that's that's an interesting and I think very helpful relief, as you mentioned, that if that sort of mismatch can be ignored because of this transition, then that certainly would be good news, I guess, for the person who's asked this question. So the other part related to this is just in terms of calculating your future cash flows. Knowing that there is going to be uncertainty in terms of rate calculations, but I think we have that to an extent right now anyways, because, the rates are getting revisited on whatever the term rate agreed, whatever the term has been agreed on. Frank, do you want to comment on that?
Yes, I guess it's absolutely the right point, Mohammed. At the moment, say for example on a normal interest rate swap, that is a fixed floating interest rate swap, and you are swapping a 1 month floating rate, you will only know your next sort of reset rate really. And you won't be knowing any of the other sort of iterations. So therefore you are creating a projected forward rate curve really. And the same applies for any sort of overnight index swaps really. And I guess I make it sound easy. I think the difficulty is then getting those settings and the curve construction right for the purpose of the valuation. And I think that's where the main challenge is. I would say there's also obviously one other element I'd say, because what has also been introduced is a payment lag, so a delay in processing the payment. So that might also impact your accounting downstream that you need to watch out. But it comes back to the systems point that I mentioned earlier.
Okay, thank you. Another question here. I think we touched on this already, but it sort of relates to there would be sort of spot rates and a backward looking. So how would this impact an end consumer? I think that in simple terms, I guess that's what it's suggesting when the question in essence is, if you don't know the rate you would be subject to until the very last day, how would you this would have an impact on the end consumer. So any views on this from David?
So I think it's interesting. So certainly in some of the banks, then we see that a lot of the banks for, say, mortgage business may have a standard variable rate, which is set by the bank itself. In that instance, to the extent that they've secured wholesale funding at the new risk-free rate, then they'll have to run that risk within their own interest rate management portfolio, interest rate risk management portfolio. So that's one aspect. But I think in other cases, where that rate, the new rate and the new setting approach is passed on to corporates, then that's another aspect for the Treasury function to bear in mind. There's obviously some additional possible liquidity risk associated with that needs to be managed. In a sort of stable interest rate environment, obviously you wouldn't expect the rate to sort of jump and move around and create a nasty surprise when it comes to be sort of set. But in more volatile periods, that risk, I think increases and could be passed on to the end user.
Thank you. One other question. I think this goes to the conversation we had very much at the outset in terms of the introduction of these alternate reference rates is predominantly to deal with the risk which was related to LIBOR and how LIBOR was calculated and so on. So how is that risk going to be managed by moving towards these alternate reference rates? My view on this is, because LIBOR was pretty much determined or based on the submissions by the bank, whereas the alternate reference rates are expected to be supported by actual transactions. This is how I understand it. And this should make, or at least help in addressing the original risk which was associated with LIBOR. So let me go to Daryl. I think, would you agree that is the reason behind, or that should allow us to address the risk associated with LIBOR by having those original and by having actual transactions supporting these rates?
Yeah, absolutely. I mean, the whole point is to reflect the activity, the markets in the millions and billions of transactions and also reflect or much more accurately, the liquidity in the market as well. So you can imagine there's an awful lot of data going into this, that on a daily basis as well. So that really is the cornerstone of how these backward-looking rates are being set, rather than something that a panel has set, sure, using data and various indicators, but setting a forward-looking rate. So it's a change in mindset to minimize risk, as you outlined. I think you're on mute.
Sorry, I was on mute. Sorry. So one more question then, and this is again an interesting one. I haven't necessarily read about it, but where is China heading with this transition? If China is expecting to be a bigger economic power, what impact it's going to have? I don't know if anyone's in a position to answer this. I look at all of you.
Well, I did note actually that markets like Singapore and other global markets are actually moving towards this. So they're sort of making signals that's the trajectory. China specifically, I can't comment, but certainly the Asian subcontinent, we are starting to see risk-free reference rates being adopted, or the plans to adopt them likewise.
Interesting, and this is again, I think a good question, and particularly relevant to banks. I think Frank, you may want to comment on this. So the question is, there is a fair bit of dependency on certain system providers when it comes to banks and so on, and potentially they are buying time to sort of have this change implemented and so on. So because again, this is not just about reporting valuation, it's sort of links to the risk systems, etc., and so on. So what are you seeing, or what would be your opinion in terms of managing this risk, where perhaps the systems are not necessarily following the timeline which is expected, or the system providers? Are you seeing that, or is there a recognition in the industry that this is a fairly big enough change that everyone has to get on with it?
Well, I would say first and foremost, this is a combination of I think the pressure the regulator puts on banks as a whole to be able to avoid having too distorted markets, shall we say. I think what is important is that that you're seizing as quickly as you can the LIBOR market, so it isn't continued to be used, because if you think about it, the less volume you have in the market on these rates, the less representative these rates are, and vice versa. So I think that's a really important point to bear in mind with this, and I think it's not something that's come by surprise. I do think, though, it's as much a challenge for the vendors as it is for the banks themselves. And I do think that it will create, obviously, an effort that where the banks have to find solutions, or temporary solutions for their systems to adapt. As long as they make progress, I think that's the important bit. I would say, though, that from the communications I've seen, at least in the UK, that if I may put it quite bluntly, there is no excuse for not having progressed towards the sort of new rates. And as I said, I think making the progress is the important bit, and there might be problems that are in the interim there in terms of system capabilities, but you do have to show, I think, that you're moving towards being able to deal with these.
Yeah. Okay. Thank you. I think that hopefully we've answered most of the questions we've received. I think so. I mean, apologies if we haven't been able to pick up on some of those questions, but we are actually out of time. We were planning to conclude this by 1:15. It is 1:15. So all in all, I think I'll just take one line, a comment from each of the panelists in terms of the key takeaways, or they would suggest our participants should consider as part of this wider change that is happening right now. So let me start with Daryl, and then we can go to Frank and David.
Yeah, as mentioned earlier, don't underestimate the significant amount of change. There's a very good reason why the regulators are scrutinizing and focused on this. It's a market, cultural, and banking change, and so it can't be underestimated because it touches every aspect of banking.
Thank you, Daryl. Frank?
Yeah, I would say in my head, the immediate thing that comes to my head is it has to be a collaborative effort across sort of different functional areas and banks, and it requires, I think, a certain mindset of sort of working together to make sure that these timelines are being met and things are well understood between sort of on a cross-functional basis.
Thank you. David, last comment from you.
Yes, I would just say that the accounting framework, IFRS, really tries to remove any obstacles or barriers that the accounting might provide. But the reliefs are somewhat tricky. So make sure that as part of the program, entities should understand how they would apply the reliefs, make sure they've got the right accounting policies in place to apply them, and also to populate the disclosures. So don't forget the accounting.
Very important. Accounting, of course. Okay, excellent. Well, thank you, gentlemen. It's been a pleasure having you on board. I know there's a lot of technical details we've gone through or touched on, not necessarily gone through, but I think the topic itself merits as those discussions. So I see Mr. Ashwak Tola has joined us as well. Who perhaps this is the busiest time of the year for him when the Pakistan budget is announced the day before, and it probably, as I said, would be having some sleepless nights for now, just working through a number of things. So I would certainly want to hear from him, but and we'll come back for concluding remarks again. So Ashwak Saab, over to you.
On a lighter side, the budget was announced in consultation with him. That's the truth in Pakistan.
Yes. Thank you, Shoaib. And thank you very much, Ali Latif, for these comments. Mr. Daryl King, Mr. David Bradbury, and Mr. Frank Stollis. I think I'm extremely grateful to you on behalf of Institute of Chartered Accountants of Pakistan that you have attended, and you have enlightened us with this important topic on IBOR, how the transition will take place. I think Shoaib, it is a dynamic leader of Shoaib that he is regularly arranging these webinars to educate our members. And I think as a transaction advisor, besides being a tax student, I have missed it a lot because of the fact that I just, it was a sleepless night and I got free early in the morning at around 10:30. I mean, in fact, it was around noon. And then I slept only for 3.5 hours, and just complying or obeying the order of my chairman Shoaib, I'm here. Although I have not taken a deep sleep of maybe 5 to 6 hours, nonetheless, it is a great, I think, honor for me to give this vote of thanks. And I'm extremely grateful to all of you for taking time out and attending this webinar and inviting our members on this important subject. I think this is high time that we arrange these types of webinar for the members. I mean, basically the world is like shrinking and things are moving very fast. I think there are so many other topics where we can give education to our members just to keep them abreast of what is moving on in the world. And I think this is one of the steps Shoaib is following. I hope that all other chairmen of my overseas coordination group will follow his footprints. And hopefully, within this tenure of myself as chairman of OCC and vice president of ICAP, we'll be having more such webinars. Thank you very much, all the participants and my dear members for attending and raising good questions. Obviously, I have missed it a lot, and hopefully, I will not miss such webinars in the future. Thank you very much, Shoaib. Thank you very much, all the speakers, for taking out time for our members. And I hope that you will join us in future programs as well. Thank you very much.
Thank you, Ashok. That's very kind of you for the words you've shared. It's been a pleasure. I'm again grateful to all the panelists and you and Ali Latif Saab as well for giving us time.
Thank you.
Particularly thank you to the team at ICAP as well, who continue supporting us with this. Akbar in particular, I think he's an excellent resource in terms of coordinating things like this. And then I'd also want to thank the managing committee members of the UK chapter who support us in the background with all of these activities. The names are Faraz, Jan Muhammad, Sharif Tareem, Manik, Maimon, and we have Syed Safiuddin. So we've got a young team, and they've got many aspirations, and I'm sure we will be doing a lot more of these in the future. So stay tuned. I think we'll have some more exciting sessions coming up your way in the coming months as well. Any feedback, obviously, I think if any of the participants or members have, please route it via ICAP, and we'll be happy to address any questions or concerns individuals may have. So thank you all. With that, I think I'll allow my panelists to enjoy a sunny Saturday, which is very rare in London, so I'll let them go. But I'm grateful to them for their time, and thank you, everyone. Have a good day. Thank you.
Thank you, Shoaib, for your hard work. Thank you.
Thank you.